In today's video, we're going to go over the pros and cons of whole life insurance. Now, here's the thing. There's a lot of controversy about permanent life insurance and whole life insurance, and should you buy it, should you not buy it, should you invest in it, should you buy term, invest the difference, should you buy some type of permanent life insurance policy and invest in your retirement. There's a lot of things that are surrounding this type of policy, and in this video, I'm going to break down exactly the pros and cons of this type of policy, and so by the end of this video, you'll know exactly if whole life insurance is right for you. What's up, guys? For those of you who do not know me, my name is Philip Setter. I'm the founder and CEO of Affinity Life, which is an online life insurance platform actually here in Canada. So you can actually view quotes 100% online and apply 100% online as well. So if that sounds interesting, I'll put the link in the description below and you can check that out. But without further ado, let's get right into the video. Okay, so maybe before we start into what is whole life and what are the pros and cons of it, I'll just give you a quick little rundown of term life insurance versus permanent life insurance, just so you can kind of get a good idea of where this stands on the overall insurance spectrum here. So term life insurance is really easy to understand. It's equivalent to renting a house. You rent it for a period of time, so you can pick a different term with term life insurance. Obviously, that's the name. So you can do a term 10, a term 20, a term 30. It's really inexpensive. It's the cheapest policy that you can get. It covers you for that specific time, and it's really meant to just cover you for a specific period of time when you need it the most, such as maybe, you have kids in the house, you just got a new house possibly, you got married, you have a job, you have car payments, and if something were to happen to you, your family would be very financially impacted, and it's meant to cover that specific period. At the end of it, however, it's really meant to be canceled. It's not meant to last you until death. So typically at age, 55, 60, maybe 65, at that point, you now have a lot of your debt paid off. Your kids are probably out of the house. Your spouse is more financially secure. And if something were to happen to you, they wouldn't be as financially impacted. Of course, emotionally impacted, but not financially impacted. So that's really what term life insurance is meant for, to cover you for that specific period of time. Now, permanent life insurance, on the other hand, is now meant to cover you until death. So term life insurance is a what if. What if something happens? Permanent life insurance is when. When is this going to happen? It's now an eventuality. So permanent life insurance, there's two different kinds. There's whole life insurance, which we're going to talk about in this video, and there's universal life insurance. So then the question comes up, well, what is permanent life insurance right for? Who is permanent life insurance right for? So a lot of the times you'll hear people saying like, well, you should maybe buy it when you're young. It's a little bit cheaper. You're investing into this policy, and we'll talk about that a little bit later on. So this question arises quite a bit here. Is like, well, who is this right for? Well, I would say this. Number one, the main reason why you would want to get permanent life insurance in the first place is for estate planning. That's it. That's number one. You want it for that eventuality, which is maybe age 85, age 90, and estate planning is one of the main purposes of permanent life insurance. So what does that mean? Well, maybe you want to pass something down to the next generation. So that could be your children or your grandchildren. You have excess savings, excess investments, and you say, well, you know what? I don't need this cash. I'm going to give it and perhaps pass it down, to the next generation, whoever that is. You could also pass it down to a charity. Maybe there's a charity that's involved in your life that's really important to you, and you want to leave a lump sum behind for them as well. That's one of the biggest reasons. The second one is estate planning in regards to taxation. So of course, when we die, everything that we owned is what's considered deemed disposed of, and it's taxed. And there are some different tax strategies and tax breaks that we do get. Of course, your principal residence isn't taxed, but if you had a second vacation home, like a second property, like a cottage or something like that, that would be taxed. And if it was important to you to pass that down to the next generation, then maybe getting permanent life insurance to cover off that tax bill could be a really good idea. Another reason you might want to consider permanent life insurance is if you have a disabled child. So if you have a child that's disabled and you know that you're going to have to financially be responsible for them for the rest of your life, whether that be when they're age 10, age 15, 20, 25, 30, 35, or 40, that could be a really good reason to buy permanent life insurance, because now it doesn't matter when, it's going to be needed no matter what. And so if you know you're going to need it anyways, it doesn't really matter what age you get it at. You could get it at age 25 or age 30 or age 35, because you know you are going to be financially responsible for that individual probably for the rest of their life. And so permanent life insurance would be a really good way to facilitate that. Which brings me to the last reason and the last thing that you can use permanent life insurance for. Now, you've probably heard this a lot from a lot of different advisors and a lot of different places on YouTube and a lot of different Google ads and Facebook ads and different content on different social media platforms is, well, you should invest in life insurance because you can use it as a retirement strategy. You can invest in it. It grows tax deferred. It grows tax free. You can pull it out during your retirement. You can use it to help purchase a car. You can use it to help fund a home. You can do all these yada yada things with it. And if you need life insurance anyways, it makes sense to maybe put it into a permanent life policy where you can then use that for those purposes and you're not quote unquote wasting your money on term. Now, here's the thing, and this is going to be my 2 cents on the topic. With term life insurance is incredibly expensive. Permanent life insurance, regardless of which type you get, is going to be roughly 5 to 20 times the amount of premium that a term life insurance product would be. So when we're talking about 5 to 20 times the amount, you want to know what you're going to get in that policy. Again, if there's a need for permanent life insurance, then it's fine. But let's talk about the investment component of permanent life insurance. So I made another lengthy video, about 45 minutes long actually, where I really broke into the nitty gritty of how this strategy works and how all the different methods of accessing this policy works and what are the pitfalls of it, and what are the tax implications of it, and how you can achieve this. And I compared that apples to apples to a traditional RRSP strategy. And so here's the thing. This strategy could be a really effective strategy, in my opinion, for the minority of Canadians who have already taken advantage of already existing proven tax strategies, such as an RRSP, a TFSA, and maybe an RESP for their children, and they've paid down all of their high interest debt. So they don't have any car payments, they don't have a line of credit, they don't have the credit cards. If you haven't taken care of all of those things first, there's no point looking into this strategy because it can be quite complicated. There's quite a few things that can go wrong with this strategy. And when you're not already maxing out these already really simple, easy to understand traditional investments or traditional tax strategies, such as an RRSP, then you shouldn't be looking at this other type of strategy. Now, with all that being said, if you are in the minority of Canadians who are in that high income earners, typically those are working professionals, such as maybe doctors, dentists, etc., or maybe those are business owners that have a high income, then yeah, this could be a really good strategy. But if you're like the majority of Canadians, you don't fall into that bucket yet, chances are you probably do not need to invest in life insurance and it's a bad idea. And if you're interested in watching that video that I made, just drop a comment below and I will send it to you and you can watch that and compare it apples to apples. With all that being said, let's get into whole life insurance, which is the specific reason why you clicked on this video. And let's talk a little bit about it and then talk about the pros and cons. And we are comparing this all in the context of permanent life insurance that you need for the previous examples, not the investment component, but you just need permanent life insurance for estate planning or you want to pass something down. That's the lens that we're going to be looking at it through, not as an investment. So with whole life insurance, it is of course a type of permanent life insurance, and how it works is you can easily compare it to a mortgage on a property. Just like you would pay down, the mortgage on your home, you can pay down the payment period on your whole life insurance. And so you can pick different amounts. So you could pick an 8-year pay, you could pick a 10-year pay, a 15-year pay, or a 20-year pay. And what that means is that's the payment term. And once you're done paying it, you no longer have to pay it anymore. You own that benefit. Just like when you pay your house off, you would own that house now. When you pay this payment period off, you now own that benefit. So it's quite flexible in the way that you can design it. And you can pick, maybe I want to pay for 8 years and get this face amount, and then you're done paying. Of course, if you passed away during those 8 years, it would still pay. But after those 8 years, it's done being paid. Now, with whole life insurance, there's this component known as cash surrender value. And cash surrender value is essentially, you can think of it like the equity within your house. It's kind of like the equity within your life insurance policy. And so there's really 3 ways that you can access this equity. Just like within your house, you need to do some things to access the equity within your house. If you sell your house, you can get it, or you can get a line of credit on your house. It's similar with life insurance. So with whole life insurance, you can either A, surrender your policy, and that essentially means that you cancel your policy. You no longer have life insurance at that point. And so if this did happen, they would pay you out this cash surrender value. And there might be some tax implications on it, depending on what your adjusted cost basis is and what the returns were, but they would pay that out to you. The second option that you can do is you can do what's known as a policy loan. Now, a policy loan is essentially a loan from the insurance company. So they're saying, no problem, we can see that you have this cash surrender value within the account. We'll give you a policy loan, and it's typically charged at maybe 5 to 7%, depending on what the prime lending rate in Canada is, and you can carry this loan and pay the interest on it and pay it off whenever you like. Now, depending on where your policy is, there might also be tax implications on a policy loan. Now, the third one you can do is something known as a collateral loan. Now, a collateral loan is where you're pledging this asset to another lending institution. So a policy loan, you're getting directly from your insurance company that you own your policy with. A collateral loan is a third-party lending institution totally separate. So let's take, for example, maybe it's Scotiabank, okay? So you would go to Scotiabank and say, hey, I want to pledge my policy. Here you go. Here's my policy. And you can kind of store it and have it as your own collateral, and I would like a loan on that. Now, the advantage to a collateral loan is that it's not going to be taxable no matter what happens within your policy. A policy loan can be taxable. A collateral loan is not taxable. And again, the rates are, depending on what prime is, but could be anywhere the 5-7% range. Now, the downsides to a collateral loan is it's a lot more difficult to obtain a collateral loan. A policy loan is guaranteed. They have to give it to you within the insurance company. Whereas a collateral loan, there's many different factors, such as what is your credit rating, what's your debt service ratio, and also how big is the policy. So that's another thing, is these lending institutions don't like to lend on this type of strategy when it's a smaller amount. So they want to see a decent amount of cash surrender value within the policy before they'll actually give a loan on it. Now, within whole life insurance, there's two different kinds. There's participating whole life insurance and non-participating whole life insurance. And so with participating whole life insurance, you're essentially participating in the returns of the insurance company. And so they're going to take your premiums and they're going to invest them throughout their company, and they're going to invest them in a multitude of different investments. And the returns that they get, they're going to return to you in one of 5 different ways. And essentially each of these 5 different ways have different mechanisms with them. But in a general rule of thumb, an easy way to understand, it's either A, going to increase your face amount, or B, it's going to decrease the premium that you pay. And so they all have their kind of minute differences here and there, and I'm not going to get into it in this video. However, generally, it's either A, going to increase your face amount, so maybe you started with $1 million face amount and it grows over time, or it's going to decrease the premium that you pay. So maybe you were paying 20 grand a year, and then with this, it's slowly decreased into 18 grand or 17 grand, etc., etc. That's really, in a nutshell, what these 5 different types of dividends that you can receive are. Now, let's talk about the pros of whole life insurance. So obviously, right off the bat, the pros of whole life insurance is 1, it's a permanent life insurance. And so, of course, if you're looking for a permanent life insurance, this is a really good option for you. 2, the biggest pro, in my opinion, about whole life insurance is that it's guaranteed. So what I mean by that is there's a guaranteed schedule for what the cash surrender value is. There's a guaranteed face amount, and there's a guaranteed premium schedule. And that's the biggest one, in my opinion, is the premium schedule. So a lot of people like certainty in their life. They want to know, hey, if I pay this for X number of years, I'm going to get this. That makes sense. We have a mortgage. We know exactly what it's going to cost. We pay it every single month. We know at the end of it, I'm done paying it. With whole life insurance, that's the biggest pro of whole life insurance, is that matter of factly, it's contractually obligated. It's not a what if, it's a absolutely when. It's not something they would like to do, it's they will do it. It's in the contract. And so if you pick a 10-year, after 10 years, it's done being paid. If you pick a 20, after 20 years, it's done being paid. That's the biggest pro of whole life insurance, in my opinion. And the third pro for whole life insurance, and this kind of goes back to that investment component and the lending requirements, is whole life insurance is a lot easier to get a loan against than universal life insurance. And universal life insurance, I'm not going to get into it in this video. However, it's a lot more complicated to get a loan on the cash surrender value within universal life insurance. With whole life insurance, it's very easy. They'll loan usually up to 90% of the cash surrender value, and it's not something that's very difficult to get. Now, what are the cons of whole life insurance? Well, the number one con of whole life insurance is that it's a higher cost. And not only is it a higher cost compared to term life insurance, it's a higher cost compared to universal life insurance. So I'm not going to get into universal life insurance in this video. However, universal life insurance can be a lot cheaper, can provide a higher death benefit. However, there's a lot more things that can go wrong with universal life insurance, and you might also get nothing. So it's a lot more flexible of a type of permanent life insurance policy. You could get a lot more face amount, you could lose everything. So if you want guarantees, I would go with whole life. If you want flexibility and a potential of a higher return and a higher face amount, go with universal life. Which leads me to the last con of whole life insurance, which again kind of goes back to this comparison between universal life and whole life, is lack of investment control. So with the universal life policy, you can essentially design it any which way you like. You can fluctuate the amount that you're putting in for the cost of insurance. You can fluctuate the amount that you're putting in for the investment. You can choose choose the different investments that you put in. You could go something risky, high return. You could go low risk with universal life insurance to design it exactly how you want it. And whole life just doesn't have that. Whole life is very rigid. It's a black box. Essentially, you're giving your premiums to the insurance company. You have no control over what they're doing with it. And you're kind of trusting in them to do a good job. And most of the time they do a good job. But if you're the type of person that wants to get really nitty gritty into exactly how it works and have flexibility over these returns, and you're a very savvy, investment savvy type of individual, then maybe whole life isn't for you. However, if you're one of those people that just wants to set it and forget it, they want the guarantees, they want the contract that says I pay for 10 years and then it's done, whole life is probably your best bet. So I hope that answered a lot of your questions about the pros and cons of whole life insurance. If you guys have any questions, feel free to drop them in the comments below. And if you guys are enjoying this content, all I ask is that you give it a thumbs up, and I'll see you guys in the next one.